Good afternoon. We have online connection. That's great. Some of the issues are the following. So what are the models and what is the predictive power of these models? Does bank analytics bring practical benefits? Is there any academic consensus in describing the FX market? What is more important, micro or macro? And our three panelists will do their best to answer all these questions in their prepared presentations. May we start with the presentations of Alexandra Isakov? May we have the presentation on the screen? We have a clicker. Dear colleagues, Sergey, thank you very much for inviting us to participate in. It's a great privilege for me to speak to the practitioners, to the members of the association. We are going to talk about our approach to forecast of FX rate. I'm going to talk about our own practice, directly and indirectly. I'm very skeptical of something like you're going to hear something drastically new, something out of the ordinary. I think that 200 years ago, when the hotel didn't exist, we had people discussing which the FX ruble rate would be. All this paper money would lead to the situation of full devaluation, and there was no bottom under the ruble.
But this is, like an endless story and an endless debate. There are many eternal and infinite issues in the world, and there are two things in the way of permanent issues and problems. Something that leads us to progress and to understanding this phenomenon, and something, well, most of the sciences are like that, and we think about a certain challenge, and cars start to move faster. But the more we think about the exchange rate, the more time we spend on building models, and better we understand why we cannot really forecast the exchange rate better. If you take a look at the economic literature of today, and my review of the economic literature from space is as follows. We only had three periods in the way of how people actually assumed or viewed the exchange rates. The ancient times, people thought that, there are simpler ways. Let's take international reserves divided by money supply, and then you would have your exchange rate. That was all the way up to 1970s. Or more sophisticated people claimed, there is an equilibrium balance of payments to GDP ratio, 2%, for example, because there is a structural outflow of capital from the country, which is like 2% of GDP. And a deviation from this equilibrium level signals this deviation of the exchange rate of the equilibrium, which would correct itself. After that, we had a publication by Mies and Rogov of 1983, who proposed to test on examples or case studies all those models and compare that with our baseline model, with the some sampling. So if today it is 78, the exchange rate of the ruble against the US, let's just see how those old models would beat the fixed rate. And any efforts of people would not make your forecast better or not. This is, of course, quite disappointing, and most of the people, it is quite disappointing, which means that all our brains, all our analytics are in vain. And afterwards, for almost 40 years, all literature was about attempts to somehow win over Mies and Rogov. And there are lots of publications on that. Mathematicians and physicists were building some neural networks that in some individual pairs of currencies and individual periods, they were able to, win over Mies and Rogov. But not really constantly. And all those results are not stable. I would even prefer to say that there are two types of all those scientists and researchers. They work in two modes: a mode of trying to explain the past, when we can dissect what happened in history and use some randomly selected factors like the fact of a risk premium or the fact that the economy was growing and the demand was growing quite fast. But when it comes to forecasts of the future, things are not so bright. Now, there are some hopes. And by the way, if you take a look at what central banks are writing on the subject, then given the fact that in the 70s, if you all remember from the reports of the central bank, you have a central bank which is following the exchange rate and using them as tools, but those central banks which are focused on the exchange rates are fewer and fewer, and so most of the people are looking at finance. Now, with the structural drop in inflation, there is a structural transition of the exchange rate effect to inflation. The exchange rate is becoming less and less important in the growth, in the growing prices. So the number of central banks who pay attention to the fluctuations of the exchange rate as the key subject in the activities of central banks, then since 2005, 2006, there have been very few such central banks. And the only lighthouse would be the European Central Bank and these people. The European Central Bank claims the Georgi and Romanchuk work of 2018, these guys say that in principle, you need to say that you don't really want to assess anything, and you use purchasing power parity, PPP, as an indicator, and assume that currencies or a deviation from the PPP can be adjusted over some time, say 2 years. And this is quite convincing for the major pairs of emerging markets currencies. And the results are better when compared to all those assumptions about the permanent exchange rate. And this parity can be adjusted. Well, if you would have questions, I would explain how those can be adjusted. But it can be adjusted basically out of two things. Adjusting the internally. So if there's an appreciation of the exchange rate inside the country, then the two things can happen. Either the nominal exchange rate would depreciate or the domestic prices would be going down. The second one actually would not happen, and domestic prices do not change really, do not go down. It is only about the exchange rate. And for the developed countries are more important for ECB, and there's an assumption that the domestic prices do not really adjust. But it was not fair for us in the past, but today we are in a world where this is quite relevant. The second work also very good if you really are interested in the exchange rate dynamics. Please read that. It is of 2020. It says that the exchange rate is going back to the median after its depreciation, but there are also two types of models additionally that people use and that we also use. The first is the beer. It's a class of statistical models where you simply assess a VAR or an equation, for example, all those models where the exchange rate depends on CDS and oil and many other things, inflation. They are about this class of models, and they say that, look, there's no benefit in accuracy from using such models, and there are also models of macroeconomic balance, which are more theoretical structural models that give you a nice story, but they cannot provide a good forecast or projection. I'll make a turning point here, and by the way, this model of the of that last class, this is something that we're using actually. We're using a model which we call quasi-structural model with rational expectations. That's our lingo. In Russian, it's more or less, well, I mean, it's in simple language, it is as follows. We have a balance of payments. I mean, I have to click many times, but that reflects the complexity of all of this. So the balance of payments, perhaps many of you understand too well what a balance of payments is, but others probably don't know what a BOP is. Let me just give you a brief story. A BOP, balance of payments, is a system of double entry to reflect all relations of a country with the rest of the world. On one side, you put all transactions and commodities and goods like exports, imports, dividends, etc. On the other side, you have the liabilities, that is, what do you finance all of those transactions above with, the investment, inflows, etc. For each of the components of BOP, you put an equation that would reflect the way you get this component of the balance of payments. That's the only slide with equations. Some of them are very simple. Obviously, the exports of oil and gas commodities depend on the price of oil and gas. More complex case in non-oil and gas exports, it depends on the exchange rate. With the low exchange rate, with the weak exchange rate, the demand for our exports is higher. The growth of the economy of the rest of the world, etc. Or the change of our external commitments much depends on the growth of our global economy. And there is a very complex equation for the financial sector, which actually reflects the complexity in trying to forecast. If oil and gas exports can be projected by, a 101 student, because it's quite simple. The growth of external liabilities is a task which is more complex by an order. And what I like best here is that this is, again, a picture from that same book that I showed to you in the first slide, and it reflects, I can just briefly discuss what is written here. Many think that because Russia has such a surplus in the goods sales, the non-residents will have to buy all the rubles. And And that was back in 1870, but it's basically happening today as well. When you're taking a look at the analysts, there is a tendency among the people whom I represent also to justify the expected movement of the exchange rate by this unilateral story of the expectations in BOP. I expect an appreciation of the exchange rate, and we say that there's a high surplus of the BOP, and the exchange rate would appreciate. But this is a double entry system, and we're talking about the outflow of capital in all cases. Then the opposite analytics describes the same story, but says that I expect the depreciation of the exchange rate because we are going to see a lot in terms of capital outflow. This is wrong. So we were kind of like disappointed by that, and we are irritated by that, and we are trying to model both the inflows and outflows, and the exchange rate is the balancing price of the outflows and inflows. When you assess the whole system, you have an exchange rate which balances both inflows and outflows, and this happens at the same time as a package. And of course, I'm taking a short track here, but when we were called for this conference, and when I tried to give you just one sentence to tell a story, probably you won't understand much. And now here you can find all our model and code, if you like. To those who are interested, we send the code, and I know that several banks are using our code for the projection purposes. You can do the same. But you can say, wait, what are you doing? It's you said yourself that it is not the most correct approach to projections. And indeed, you may think that you can go back to your market data, but if something big happens, like, going to the fiscal rule, you don't have another method of understanding or appreciating or logically discussing this in the vocabulary of statistical models. So what is this fiscal rule for the exchange rate? If you're building a regression or a statistical model, it would say, no, I don't know. Let's wait another 5 years while we accumulate data, and then we would understand the impact of the fiscal rule. Hard to do, but in our case, what we did was that we simply changed the equation of the accumulation of international reserves from what it was, like almost a zero, because any change in the international reserves is zero for your rule. And we replace it with this equation, which, trust me, it reflects the essence of the fiscal rule in BOP terms. With the current parameters of the fiscal rule, for $1 of the surplus price of oil, you accumulate $2 or $3 billion in your budget. That is, you replace your budget, you replace your change of international reserves equation with this equation, that with this price of oil, you would have this automatic accumulation of additional international reserves, and you would be getting automatically this result, which you all very well know. That is a more flat curve of dependence between oil and the exchange rate with a new fiscal rule in place. And this you can do, and without waiting for enough data to be accumulated on that. And additionally, when I came to FTB Capital, what we started to do was that as part of this revolution of sorts that we did, we on our website, where you can download our projections, we also keep all our archived projections so that you can understand what we projected 5 or 6 years ago. And all those archived projections are kept on our website. If you are interested, I would add you to our website so that you can have access to our archived projections. Thank you. A very interesting presentation. Yuri, how do you see the whole picture in Sberbank? Good evening, dear colleagues. If I can have my presentation as well. Well, Alexander's launched a very interesting discussion and provided quite fundamental reasoning. And I agree with him, generally speaking, that it is quite difficult to project the exchange rate of the ruble. So sometimes the projections fail, but there are analysts who are paid a salary to do some job. And so they want something from us for our salary. What they pay us for our opinion, I would say. And yes, we may be making mistakes about our projections, but there are some opinions, trivial or quite complex, but these opinions can be based on some models as well. Кликер сломался наш кликер. Okay, so let me just come to this slide with a picture, with a graph, and tell you about the model. As I mentioned, I believe, and you would want to have a clear vision and opinion of an analyst. That this is the value added of an analyst. And to get this opinion, you still need to understand what is happening with the exchange rate. Why today the ruble appreciated by 3%, and why it went from 78 to 77.5 per dollar. And we write daily reports where we actually try to provide the reasoning of that. So why the exchange rate is at a point where it is now. You can identify a number of factors there,
which would drive the daily rate, and try to have a model based on that. In case of the ruble, there are three major fundamental factors. The first one is the USD against emerged markets currencies. If USD appreciates against euro, it's going to appreciate against ruble as well. This is the ruble against the USD against emerging markets currencies. If we see a risk off and the drop of such currencies, the ruble is going to follow the suit. The third is oil. Yeah, the fiscal rule has weakened as dependence, but it is still in place. It is statistically important. And we can think about fundamental factors is the risk premium. In my model, CDS, the excessive growth against emerging markets currencies. The model itself is working quite well. This is a linear regression with Gaidar process on the balance with the revolving volatility. It has quite a very interesting explanatory component and logarithmic changes the square r squared to 60, which is quite high. So there is a task to assess the risk premium. As for the risk premium, it's quite simple. It is the premium for sanctions in case of Russia. And we have such an event, a key for our market. These are the sanctions against Rusal. So the graph based on my model started in April 2018. As before that, they talked about sanctions, but nobody really believed in that. But when Rusal case happened, everybody started to believe in that. And 2.5 years later, the issue of sanctions is still very dangerous for the mindsets of the investors and the key driver of ruble rate. We can say that ruble has 3 fundamental factors. 2 fundamental and 1 non-fundamental one. Oil, USD against many currencies, and the risk of sanctions. The model based on logarithmic increment allows to demonstrate how ruble has changed, what it has been driven by. And we can see that starting 2018, step by step, in the dynamic of ruble, the more impact was by USD index against many currencies. If there are trade wars, so the USD appreciated against many currencies, so the appreciation of USD didn't allow the ruble to appreciate. And if we calculate the effect of oil and USD rate, the sanction component was decreasing. This is quite a clear result. The sanctions cannot be imposed constantly. Sanctions are imposed, as in Rusal case, lifted. So the new sanctions are imposed again in 2018. How did it evolve? Then we had Rusal in August 2018. Russia was threatened by sanctions against federal loan bonds. In August, the sanctions premium in USD RUB pair was about 13%. Just before the elections in the US, this issue was very relevant. But the elections were over, the sanctions didn't occur, so the premium was fading step by step. The same picture we can see right now. Economist estimates. I do agree with Alexandra that all the models are kind of conditional ones, but if you look at the opinion, it is a kind of a trust, and which is underlined by something, as it seems to me. Something is captured by the model. At the beginning of the year, Economist estimates there was no sanction premium. The premium was negative, so ruble was overestimated, and corona crisis happened. The premium went up, oil went down, the USD appreciated globally, and ruble reached this bound of 80 rubles against dollar. The premium then disappeared in June. According to my estimates, it was not in place, and starting with June, the situation like that in 2018 started in the US. They started to talk about the severe sanctions. We remember that Russia had kind of unfriendly interventions with the US in Afghanistan. Since the pre-election campaign was gaining momentum, the topic whether Russia was supposed to be accused of meddling with the US elections, that's what we saw what we saw. The ruble dropped, and the premium reached a very high level. According to my estimates, around now it's about 14%. Talking about the equilibrium rate, the current USD against ruble should be 14% less. It's around 86 against dollar. The model is clear, but can you somehow this sanction premium assess independently of other factors, or it is just mistake between other factors and reality? It is the sum of what CDS volatility gives and the mistake or error by unexplained factors. Can it be assessed independently? Frankly speaking, it seems to me that my approach is quite logical. They deal with the following. With sanctions, with higher sanctions risks, the ruble is depreciating, CDS is growing. This is the reaction to the sanctions threat. Ruble is depreciating against many currencies. It's clear, but if you go the difference between the model on particular factors and the real situation is a sanctions premium, this is a kind of trivial approach. If you cannot assess that independently, we understand that you have a model, you have reality, and you have a kind of error. The world is noisy. But the question is, if you call it an error and call it a sanction factor, can you just try to assess this factor independently based on the analysis of news, headlines, so on and so forth? So that on this graph, you can see just error, separate error. You can assess this factor using different model, but this is not going to disappear inside this model. The idea is that there are fundamental factors where we see how they're changing, we see the impact on the rate. We'll look at the situation, whether it is the rate, and we see the difference, and this is risk premium. We have 15 minutes for our panel discussion. We need to give the floor to Anna. A couple of concluding words. As a conclusion, Alexandra mentioned beer model, behavioral exchange race model. The results are almost the same, and the risk premium, based on my estimate, we of course have expert opinion factor that's very close to the levels like we have in our previous model. So the number is 12%, so it gives the model of equilibrium rate, unlike the first model where you need to artificially choose the point from which you show the results. But the drawbacks is that it is based on the monthly basis or the period of time. The elasticity of currencies against different factors, for example, fiscal rules, the impact of CDS is lower than it was 10 years ago. There are some problems. It is an alternative estimate, and it gives the same findings. To conclude, I would say that something can be touched and assessed. Sanction premium is not a fundamental. It disappears at the end of the day because sanctions cannot be imposed constantly. Something can be assessed. From my perspective, it works. Thank you very much. If we have several minutes, we'll look at the questions. Right now, I'd like to give the floor to Alexandra. Alexandra, it's your turn. Could you please express your opinion, whether there is an academic consensus? How do you agree with models and estimates which have been presented before? Maybe you have your own approach to the problem. Good afternoon. Can I be heard? We are ready to comprehend. Good evening. Thank you for the opportunity to take part in such a very interesting summit. I'd like to thank our previous speakers. It's interesting to hear different approaches to model FX&Rate. What I'm going to elaborate on is going to overlap with those things our colleagues have expressed. expressed already, I'd like to mention that current FX rate modeling is a very important task, as over the last several years we've witnessed real FX risks which have impact on inflation, on the real sector of economy. And so kind of estimate and evaluation of fair equilibrium rate are very relevant. First of all, I'd like to draw your attention to the following picture. On the graph, you can see the dynamics of the nominal effective rate in, and then in this, then we have inflation and we have real rate. I'd like to mention that it is very important to study the dynamics of FX rate, considering the period of the research. If we look at the period before credit crunch, the nominal FX rate is a kind of a plateau within the fixed FX rate, and the real FX rate is a kind of upward trend, the dynamics of which was determined by the inflation. In this respect, we can say that the adjustment of real rate to its long-term equilibrium rate due to some shocks, externalities, is happening for a long period of time, around 2 years, and it's happening due to price changes with the fixed nominal rate. If we look at the time after credit crunch, we can see that the lines for nominal and the real rates are moving in line. This is connected with the flexibility of FX rates and then shift to inflation targeting. So the real rate started to adjust to its long-term equilibrium rate. According to our estimates, this lasts around 2 to 3 months. We see that the whole structure, the whole design of the real rate dynamics is varied depending on the time period. So while modeling, while simulating, we need to look at that. Talking about nominal and real FX rate factors after the credit crunch, talking about short-term factors which have impact both on nominal and real rates. We need to mention the global uncertainty concerning the global economic growth, disbalance on the oil market, which was priced in the trading circumstances of the Russian markets, the reductions in interest rates, sanctions, threats, instability on emerging markets. And the last point, which our colleagues have mentioned, is connected with FX interventions by the Ministry of Finance under the fiscal rule, which started to have impact on FX rate. On this slide, you can see several arguments. Within our research, we pay a lot of attention to switch to a new fiscal rule and to attempts to understand how this impacts the FX rate. Here we have a list of arguments which prove that the fiscal rule has its own impact. This is the correlation between FX rate and oil price. The interdependence went down twofold starting April 2018. Apart from that, talking about econometric models considering market situations, they identify the regime of non-flexible FX rate pricing starting February 2018 when a new fiscal rule was adopted. A couple of other assessments which prove that as a result of fiscal rule, ruble, and the impact was underestimated in a number of episodes. We need to speak about high-frequency models of FX rate. If we look how we add these models to interventions by Ministry of Finance, we see a downward pressure on ruble rate. Now, next slide, we give an example of one of our econometric models, which we use to evaluate the FX rate. This is the model of real rate. We're interested both in the dynamics of nominal and real rates. We're closer to the behavioral approach in modeling FX rate. Forecasting FX rate, we have fundamental factors in place, such as so-called Belas's and Mason effect, or labor productivity in Russian economy against foreign developed countries. We have the real oil price and net foreign assets by private sectors. These are variables, and they correspond to theoretical approach. This is a long-term ratio. So, using real variables in this model, we can see how the real rate is different from its modeled one, or so-called fair equilibrium rate. On this slide, you can see two lines. And the interrupted line is model fair equilibrium, so-called equilibrium rate. And in a line without interruptions, you can see the real FX rate. I'd like to draw attention to the following thing. First of all, we can analyze different points, but I'd like to focus on the last point. Starting 2017, we have been witnessing significant underestimation of FX rate, so it is quite lower than the modeled one. Evidently, the fiscal rule, according to our estimate, is around 9 to 10%.
On this next slide, we have the nominal exchange rate model. Again, this is more or less like a behavior-driven approach, as the fundamental factors of the nominal exchange rate is the classical set of the oil price, the gap between interest rates in Russia and LIBOR, as well as a financial stability indicator. In our model, this is the volatility factor in the BRICS countries. Plus, we add another variable for the fiscal rule, which assumes the value of 1 as of February 2017, when that fiscal rule was introduced and started to function. Now, noteworthy here, so the signs here in terms of theories would match the theory. First of all, and plus you can see that if we assume the absence of a fiscal room, then the elasticity of the nominal exchange rate by the oil price is 0.3. However, with the fiscal rule in place, we are looking at the joint effect of the two factors of the oil price and the oil price times by the time variable, and we get the volatility of about 0.82. There is a close correlation between the terms of trade and the exchange rate, which testifies to the fact that it is quite efficient given the fact that the fiscal rule is there to decrease the more or less the effects of the terms of trade and exchange rate. And the final slide here, we're talking about Q3 of 2020. We know that the exchange rate again depreciated to the dollar by about 14%, and we have a list of the key factors that we believe to have some effect on such depreciation. And according to our estimates, based on the models that I presented to you, the fair equilibrium value of the nominal exchange rate of the ruble is about 71 to 72 rubles to a dollar. And this is again for Q3 of 2020, which more or less speaks about the undervaluation of the ruble, quite significant one. We believe that in the absence of new shocks, in the more stable geopolitical situation, slowly the exchange rate would really go to its fundamentally justified value. Given the plans of the central bank and of the Ministry of Finance of selling FX domestically, these transactions, of course, would provide some support to the ruble. Thank you very much. Thank you, Alexandra. Well, in conclusion of our session, I would like to really show to you the outcome of our poll, and the question was, do you take into account the opinion of analysts and experts when deciding on the FX market transactions? And I congratulate all the panelists here that indeed most of the respondents think that analytics is useful.